In the last example, we saw that if the company wants to move closer towards their target capital structure, they needed to use debt finance. Now, there won't be only one form of debt finance available. There'll be multiple forms of finance available. The company might be able to go to their bank and raise a loan. They might be able to enter into a lease. The supplier of the asset might be able to provide them with finance. They might be able to issue debentures, for example. So various different forms of finance exist, and it's important that you are able to calculate the most cost-effective form of finance, or in other words, the cheapest form of finance. And you can perform this calculation in either one of two ways. Either you can calculate the internal rate of return, or you can calculate the net present cost. Please note, when we are looking at the financing decision, as we are in this lecture, the internal rate of return method is preferred. All right, guys, so what we're going to do now is let's jump to the lecture examples, work through a couple of examples, and when we come back, all of this makes a lot more sense. So please go to your lecture examples. Watson Pty Limited is currently considering various financing options for a new investment with a cost of 2 million rand. One alternative is to obtain a loan from their commercial bank who will advance 75% of the investment cost. All right, so they won't be able to get a loan for the full amount, but only 75% of the investment cost. So their commercial bank is prepared to give them a loan of 1.5 million rand. 2% transaction costs will be payable immediately. The loan will bear interest at a fixed rate of 11% per annum. So guys, this is your coupon rate, which you are going to use to calculate your interest cash flow. There's a final bullet payment of 500,000 Rand at the end of 4 years. And in addition to that, there are also equal annual installments, including interest and capital. The loan qualifies as an instrument as per Section 24J of the Income Tax Act. So what does that mean? If Section 24J of the Income Tax Act applies, it means the company will get the tax deduction for interest as the interest accrues over the period. So you don't get the tax deduction when the interest is actually paid, you get the tax deduction as the interest accrues over the loan period. Please note, if the question is silent, you should assume that Section 24J is applicable and the company will get the tax deduction as the interest accrues over the loan period. If you are specifically told to ignore Section 24J, then it means the company will get the tax deduction when they actually pay the interest. And in this question, you need to calculate the cost of the loan, or in other words, the internal rate of return. So you're going to break your calculation down into two steps, and in step one, we are going to calculate our cash flows. Guys, you cannot calculate the internal rate of return if you don't know what your cash flows are. So first we calculate our cash flows, then in step two, we will actually answer the required and calculate the internal rate of return after we know what our cash flows are. Please note, in step one, when you are calculating your cash flows, you ignore tax and transaction costs in this step. So let's look at our cash flows. The commercial bank is prepared to give the company a loan of 1.5 million Rand. So the present value is 1.5 million Rand. The period of the loan is 4 years, so N is going to be 4. Please note, we are calculating our cash flows. So when calculating our interest cash flow, you use the coupon rate. So the interest rate that you use in your calculation over here is 11%. Once again, guys, we are ignoring tax in this step, so you just use 11%. Don't get the after-tax rate, it's the rate before tax. So it's important to note, this is the coupon rate. We use the coupon rate when we are calculating our cash flows. All right, and it's the rate before tax. Please make sure that you ignore tax. Then we know that there's going to be a bullet payment at the end of 4 years, a bullet payment of 500,000 Rand, and in addition to that, equal annual installments including interest and capital. So for the future value, we have a bullet payment of 500,000 Rand at the end of year 4, and you're going to compute your payment, which will give you your annual interest and capital installments. Right, simple calculation, ignore tax and transaction costs. We've now calculated our cash flows. Here's your cash flows. Initially, when the company entered into the loan agreement, they have an inflow of 1.5 million Rand. Then, at the end of 4 years, they have an outflow of 500,000, plus they also have equal annual payments made up of capital and interest. You've calculated all of your cash flows. Now that we know what our cash flows are, we can go on to step 2 and we can actually answer the required. In other words, calculate the internal rate of return. Please note, in step 2, you should only ever include future cash flows in your calculation. The company does not yet have this loan. It's not an existing loan. This is new finance. So all cash flows are going to be future cash flows. This is new finance. So the full period of the loan is 4 years, so we include the full loan period in our calculation because all of your cash flows are future cash flows. This is not an existing loan. This is a new loan that the company does not yet have. Now, what I recommend you do, in step 1, we calculated all of our cash flows. First, input all of your cash flows onto the table. So we know initially when the company enters into the loan agreement, we have an inflow of 1.5 million. We have a bullet payment at the end of year 4, and we also have equal payments throughout the loan period, or equal annual payments made up of interest and capital. So those are all of your cash flows from step 1. Include all of those cash flows in the table. Then, in step 1, we ignored tax and transaction costs. Now, you just need to take tax and transaction costs into account. So let's start with the transaction costs. There are 2% transaction costs payable immediately. So as soon as the company enters into the loan agreement and they get the 1.5 million Rand, they're going to have to pay 2% transaction costs. Obviously, that's an outflow. Simple calculation. However, please note, guys, the company will get a tax deduction for these transaction costs. So there's a tax benefit. So take the transaction costs and multiply by 28% so that you can get the tax benefit on those transaction costs. Please note it's a tax benefit or a tax saving for the company, so it must be shown as a cash inflow. Now, why does this jump back? Why do I have the outflow in column 0 and then the tax saving in column 1? Guys, please remember, column 0 is the beginning of year 1 and column 1 is the end of year 1. So beginning of year 1, end of year 1. That's the only difference between the two. At the beginning of the year, the company will enter into the loan agreement and there will be an outflow of 30,000 Rand for the transaction costs. However, the company doesn't do their tax return upfront at the beginning of the year. When will the company do their tax return? Only at the end of the year. So even though they pay the transaction costs upfront at the beginning of the year, they will only do their tax return at the end of the year. So they only get this tax benefit at the end of the year when they actually do their tax return. So please just take that into account in your calculation. That is extremely important. All right. So we've included the transaction costs in our calculation, and we've also taken into account the tax benefit on those transaction costs. Now we just also need to look at the tax on any interest payments, because remember, interest is tax deductible. And in this question, we are dealing with Section 24J of the Income Tax Act, which means the interest is deductible as it accrues over the loan period. So what do? In step 1, you input all of this information into your financial calculator. Keep that information in your financial calculator. Then, using the amortization function on your financial calculator, you're going to pull out the interest for period 1, 2, 3, and 4. So this is the accrued interest. Guys, even though you are using your financial calculator, don't just use the financial calculator and write down your answer. You must show your calculator steps, otherwise you will not score these marks. All right, so using your financial calculator, get the accrued interest for periods 1, 2, 3, and 4. That interest is going to be tax deductible. So multiply that by 28% so that you can get the tax saving in year 1, 2, 3, and 4. And then you include that tax saving in your calculation above. So please note that is a tax saving. It is shown as an inflow. The company gets a tax deduction for the interest, meaning it reduces the amount of tax that they need to pay across to SARS. Please also always show the tax rate. There's a consequential mark available for showing the tax rate. Now guys, as an alternative, instead of using your financial calculator to get the interest that accrues over the loan period, you can also draw up an amortization table. I don't recommend drawing up the amortization table. This is going to take too much time. You won't have enough time in a test or exam to set your answer out like this. Please use your financial calculator. You've got the financial calculator, use the financial calculator. I've included this amortization table over here so that you guys can understand the logic of what your financial calculator is doing. You shouldn't just use your financial calculator without actually understanding what it's trying to achieve or what it's actually doing. So the amortization table over here shows you the logic behind the calculation. It shows you how to actually calculate that accrued interest over there, but you don't need to worry about actually drawing up the amortization table. Please rather use your financial calculator. It's much quicker. You get your accrued interest from the financial calculator, multiplied by 28% to get your tax benefit in each of the years. Then guys, it's also not necessary to show this calculation over here because you've used your financial calculator. But you must obviously show your calculator steps, otherwise you're going to lose out on those marks. All right, guys. So in step 1, you get your cash flows. In step 2, you include all of those cash flows on your table, and then you also take into account tax and transaction costs. You can then total all of your cash flows. That's everything. Input all of the cash flows into your financial calculator and solve for the internal rate of return. And please note that the internal rate of return is going to give you the after-tax cost of this loan. So this loan has an after-tax cost of 8.5%. How do I know that that's the after-tax cost? The cash flows above are after tax. So if the cash flows are after tax, the internal rate of return that you've calculated over here is after tax. Now guys, in a real life situation, you won't only have one form of finance. You'll have lots of different forms of finance. You'll have various different loans, debentures, etc. You perform this calculation for all of the different forms of finance. And if you are trying to determine the most cost-effective or the cheapest form of finance, you select the alternative with the lowest internal rate of return. So the alternative with the lowest internal rate of return is going to be the cheapest option. All right. So guys, in this example, I showed you how to calculate the internal rate of return. As an alternative, instead of calculating the internal rate of return, you could also calculate the net present cost. So in the next example, it's exactly the same information. However, now, instead of calculating the internal rate of return, you are going to calculate the net present cost of the loan. And in order to calculate the net present cost, they need to give you the after-tax cost of debt. So you've been told that the pre-tax rate on similar loans, so if that's the rate on similar loans, that's the market-related rate, and that is 13%. That is going to be the cost of debt. And please note, when we are calculating the net present cost, we use the after-tax cost of debt as our discount rate. Now, this is the first difference between the last example and this example. In the first example, you had to calculate the internal rate of return. Please note, when calculating the internal rate of return, you are calculating the after-tax cost of debt. So because you are calculating the after-tax cost of debt, they don't give you the cost of debt in the scenario. So in the scenario, you are not given the cost of debt, you are required to calculate the cost of debt, or the internal rate of return. In the next example, because they want you to calculate the net present cost, they need to give you the cost of debt. You can't calculate the net present cost if you don't have the cost of debt, because you are going to use the after-tax cost of debt as your discount rate when calculating the net present cost. All right. Now you'll see most of this example is exactly the same as the last example. In step 1, we calculate our cash flows. This is identical. I just want to point out, when calculating your cash flows in step 1, you use the coupon rate, so the interest rate on the loan, in order to calculate your cash flows. Always use the coupon rate when you are calculating your interest cash flow. Do not use the cost of debt, so don't use the 13%. Then, after you've calculated your cash flows in step 2, you are going to answer the required and calculate your net present cost. Here, the second difference comes in. Go back to the last example. In the last example, when you are calculating the internal rate of return, you need to include the initial funds received in your calculation. So when calculating the internal rate of return, we include the initial funds received in our calculation. On the other hand, when calculating the net present cost, you do not include the initial funds received in your calculation. Other than that, you'll see that all of your other cash flows here are exactly the same as the last example. All of these are exactly the same. So the only difference is you don't include that initial inflow of 1.5 million when you are calculating the net present cost. Total all of these cash flows over here. Include all of the cash flows in your financial calculator. You are going to use the after-tax cost of debt as your discount rate. So please note, in the question you were given the pre-tax rate. So you just need to get the after-tax rate. So your cash flows over here are after tax. And the discount rate must also be after tax. Include all of the cash flows in your calculator. Use the after-tax cost of debt as your discount rate and calculate the net present cost. Once again, if you have lots of different types of finance, the alternative with the lowest net present cost is going to be the cheapest form of finance. All right, so that is how you calculate the internal rate of return and the net present cost. Go back to your lecture notes quickly. Let's just make sure that you're happy with everything over here. When we calculate the internal rate of return, you take all of your financing cash flows. So your financing cash flows are interest and capital repayments on the loan, any transaction costs, etc., and you must also take the tax consequences into account. So interest is tax deductible, transaction costs are tax deductible, etc. So take all of your financing cash flows and the tax consequences into account. Please note, you'll remember, when calculating the internal rate of return, we include the initial funds received in our calculation. How does this differ if we are calculating the net present cost? We still calculate all of our financing related cash flows, so the interest and capital that needs to be repaid on the loan, transaction costs, and all of our tax consequences. However, now the initial funds received are excluded from the calculation. So when calculating the internal rate of return, we included the initial inflow of 1.5 million rand. We now exclude the inflow of 1.5 million rand when we are calculating the net present cost. With the internal rate of return method, we input all of the cash flows into our financial calculator and we solve for the internal rate of return. When we were calculating the internal rate of return, we did not need the after-tax cost of debt to perform the calculation. So if you are given various different types of finance in a question and they want you to calculate the most cost-effective form of finance, if they don't give you the cost of debt, you will be forced to calculate the internal rate of return because we don't need the cost of debt when calculating the internal rate of return. However, on the other hand, if you want to calculate the net present cost, you need the after-tax cost of debt because we use the after-tax cost of debt as our discount rate. So with the net present cost, you are going to input those cash flows into your financial calculator, just excluding the initial inflow, and you calculate your net present cost using the after-tax cost of debt as your discount rate. You can't calculate the net present cost if you do not have the after-tax cost of debt. If you don't have the after-tax cost of debt, you are forced to perform the calculation using the internal rate of return method. Okay, so you can see that. This method should be used if you have not been provided with the cost of debt. If the question is silent, you can use either method, but please remember, the internal rate of return method is preferred for the financing decision. Then, if we are trying to determine the most cost-effective form of finance and you have various different types of finance available, the alternative with the lowest IRR is the cheapest, or the alternative with the lowest net present cost is the cheapest. So that's how you make your decision. Select the alternative with the lowest internal rate of return or the alternative with the lowest net present cost. Then please note, guys, this calculation does not only relate to loans. I've showed you the calculation of a loan because a loan is a lot more complicated than the calculation for a debenture or a preference share. However, this calculation, or you should be able to perform this calculation for any form of finance. So you should be able to calculate both the internal rate of return and the net present cost for loans, for debentures, for preference shares, for any form of finance. But you follow exactly the same logic as what we did with the loan. All right, it's exactly the same. The loan is just a little bit more complicated, and that's why I've worked through the loan example with you. If you would like to work through another example, you can. You can work through lecture example 2.3. So the purpose of this example is to show you that this financing decision does not only relate to loans. The exact same logic applies to all other types of finance. All right, so please work through that example on your own.